Morgan Stanley had record earnings with comfortable revenue beats in all business areas. Revenue up over 60% year over year, return on equity over 20%. But grabbing the headlines are the disclosures that they lost $911 million relating to the Archegos capital blow-up, which on one level makes the record numbers all the more impressive. However, this loss took the market by surprise since nothing had been disclosed previously, and indeed many reporters had been led to believe there was no material loss. James Gorman explained why no disclosure on the earnings call.
We're in a quiet period. So, there's things there are certain times when you can't comment about the business unless you sort of pre-announce earnings, which we weren't going to do given that it was a record.
Disclosures aside, why was Morgan Stanley's loss bigger than Goldman Sachs? Well, first and foremost, based on conversations with sources, the size of their relationship with the client. They were the #1 prime broker for Archegos, who'd been a client for about a decade. Goldman Sachs was not even top 3 and only recently took them on as a client. Second, the importance of Viacom CBS in all of this, which Morgan Stanley had been the lead underwriter for of a secondary placing that had taken place earlier the week of the blow-up.
By the fact that one of the large single stock positions related to a security in which we had been an underwriter, and we thought the right thing to do was to close that previous underwriting, which happened on that Friday. So we had to hold off, which caused us to be later than some, if you will. And, the reason for that was not that we weren't aware of what was going on. We just felt we had an underwriting obligation to deal with.
Morgan Stanley sold around 13 times more stock in the secondary than Goldman Sachs, who therefore decided they could start selling the stock sooner. A senior source implied there's no hard feelings on this front from Morgan Stanley to Goldman Sachs, but rather that Goldman was just in a more convenient position. Morgan Stanley felt that while selling sooner wouldn't have broken rules, it wasn't the right thing to do as lead bookrunner. Also worth noting that Morgan Stanley had much bigger exposure than Credit Suisse and Nomura, but significantly smaller losses, which is down to a number of factors. The most important being size of collateral required and speed of deciding to exit positions in full once things started going wrong. The central problem running through all of this, the different prime brokerage units didn't know they were all taking the same positions for the same client, described by a senior source as not illegal under current rules for family offices, but certainly not expected. Here was some comments on the call from James Gorman about how regulation might change going forward.
I think, we'll certainly be looking hard at family office type relationships where they're very concentrated and you have multiple prime brokers. And frankly, the transparency and lack of disclosure relating to those institutions is just different from the hedge fund institutions. And that's something I'm sure the SEC is going to be looking at, and that's probably good for the whole industry. Better information is always good in rooting out where potential problems can be.
On the earnings call, the CFO, Jonathan Prusen, also touched on how the uniqueness of the situation meant there was less concern for the rest of the prime brokerage business and indeed for market functioning as a whole.
It really came down to the fact that this firm had large positions, the same positions in the same names at other banks across the street, and it wasn't apparent to us. So I think that's what isolates the situation here or makes it more unique. We've scrubbed the portfolio. We haven't found anyone that has similar fact patterns or copycat strategies, and we'll continue to be diligent around all of those points.
Bottom line, a person familiar with the matter is, of course, regretful that they had a client loss that led to $900 million of losses, but they cannot run the business looking backwards and are happy with the prime brokerage business long term, and indeed had a record quarter for the firm, for the securities business and for the equities business, despite that big $900 million loss.